to borrow Javier Blas' term in his recent piece, is the potential mother of all oil supply disruptions. Because we're not only talking about, Israel striking energy infrastructure inside of Iran. Once Israel does it, it opens up, it gives the green light to Zelensky to do it to Russia. And then the retaliation coming from, Iran into the other side of the Gulf, or Russia into it just opens up a can of worms that we haven't seen since the 70s.
But Jeff, the market is, largely shrugging it off. So what's going on?
Yeah, I think it's to the broader point that the market in oil, commodities more broadly, has been unwilling to hold a position on anything. Whether if it is, look through the current, uncertainty around China to see for the stimulus as it's going to improve. And I think it goes to that short-term, near-term, myopic approach of trading oil. Where do we see the positioning in oil? It's in the options, which is part of the reasons why we see big moves like yesterday, down 3, up 3, that kind of move, because you do have positioning in the options because it's the easier way to hold the position. But overall, open interest in oil, it's at a one-year low. The market's not long, it's not short. Positioning is really weak.
Okay, but so by your calculations, first of all, what's the risk of a significant supply disruption? And, could oil just go to $100 all of a sudden?
It's never been this high in our lifetimes. Well, I wasn't around in the 70s to, trading oil at that point in time, but in the time I've been doing this for 3 decades, I've never seen it this high. And I think, one of the differences, we have more transparency of it, and we can find out when it's going to happen and know what the infrastructure that could be hit here. And by the way, it's more likely to be refineries than it is to be, upstream oil assets. But I think the key point here is, it's never been this high of a probability. And we're talking low inventories.
So you think it's never been, the probability of a significant supply disruption has never been so high in the last 40 years?
Yeah, it's probably in that 30% plus range, if not higher. And we look at the complacency of the market, both from the disinflation narrative. We look at positioning in oil, but let's take the war out of the picture. The underlying demand dynamics in oil are very supportive right now. You have, let's start with the U.S. You just had rate cuts on top of, a gangbuster jobs report. The dock workers just got huge pay raises, so that's U.S. You have liquidity going up. Let's turn to China, a stimulus package, liquidity going up there, even a growth impulse coming out of Europe. You put the three together, you have global liquidity turning up, growth impulse turning up. That's the ideal time to buy commodities.
Right, but so are you telling me that oil should be at $100? If you're saying there's a 30% chance of a severe supply disruption, the market just doesn't make sense.
Take the supply disruption out. The market should be trading in that $80+ range. So, I think you put that supply disruption on top of that. How do you handicap that? We should be sitting, at least $10 higher than where we are right now.
So should OPEC Plus actually delay their production increase that they're expected to do in December?
Well, if we look at overall demand, it's improving. That the market is in a deficit. That's the part that the forward curve is backwardated. There's this belief of this oil supply glut, but the evidence of it, I think, is not that substantial. And I think the bottom line is, the overall demand is above supply. There is room for them to bring on that production.
Even next year?
And we don't know. When we look out over next year, the forecast of that surplus keeps coming down. The EIA put one out yesterday of 200,000 barrels per day. That's getting close to zero. But how do we know what's going to happen to Saudi Arabia? Are they going to replace Iranian production in 3 weeks' time? We don't know those things. And so I think taking a strong view, we're in a surplus because fears around Chinese growth when they just, hit the stimulus button, and the onshore people believe it more than the offshore people. You look at production in the U.S., it disappointed yesterday. It came back down. So that growth is not materializing. And then we look at the spare capacity in places like Saudi Arabia. It could be swapped out for Iranian production in 3 weeks' time. So why is this bearish impetus in the market is beyond me.
But so, Jeff, when I hear you speak, there's nothing really that the market is getting right about this, right? Not the oversupply next year, not what's happening now, not the pricing next 3 months.
I think what's going on is it's too hard to hold the position, and they don't want to hold it. Up, down, $3 a day, that type of volatility. It's easier for me to sit here and talk to you about it than to actually somebody trying to hold the position.
Right. So when does that change? Again, if we talk about a war premium, what needs to happen for that to
I think that the market's in that show me mode. They actually want to see it. They're not going to price it in until they actually see it, which unfortunately will be too late. And I think that it's the same thing in some of the other markets like copper and the rest of them. They're in that show me. They're unwilling to hold a position until they see the fundamentals. They got to see it actually happen before they put it on. It's that momentum, the momentum type strategy. So it's not there right now. Instead, it's this as opposed to that.